YouTube, you guys got to check out this show. This is a great conversation. Justin, what'd you get out of the show?
Man, first, our guest is from Canada. We're talking about investing in Canada, A-class properties. You will not believe the cap rate that Larry is buying these properties at, but the incredible rental upside by buying those properties. You have to check out this video.
What's going on, YouTube? It's Matt Faircloth. Welcome to the Mentorship Monday program.
Today, our guest is Larry. Larry is coming on. Hey, Larry, how are you today, man?
Well, thanks. Thanks very much.
Tell us what we can do for you today.
Okay, so I'm part of a small investment group. It's a family and friends sort of deal. We started a couple of years ago, bought a small building, $650,000, 5 units, just to work things out, figure out if we like it, how to make deals and how to run things up. So 2 years later, we just closed on our third building. It's 2.85 million, 12 units, cap rate 3.6. So we closed in Christmas. It's gone pretty well. We've already had a couple rents turnover, been able to bump the rents from 11 to 1,500. So things are going well. The building's in good shape. There are no sort of mysteries that we didn't discover till later. We've been financing primarily our own money for the down payment, about 34%, and the rest coming from the bank, conventional mortgage, prime principal and interest, 3%. So basically, there's very little cash flow because you're buying at 3.6 market cap, interest rates 3%. So the cash flow in the first couple of years is next to nothing because of the principal, right? We have to pay down the principal. So now we got another deal brewing. It's for 2 buildings. This is just outside of Toronto. 4.4 million, market cap's 3.6. Our guys are like, you know what? We don't want to put any more money, our personal money into it. Like we've done it. We're all like in our 40s and 50s. We all have jobs or other businesses. This is not something that's going to make us, multi-millionaires. So we're trying to figure out, how do we get this deal done? Number one, is it worth to get the deal done? I want to ask you guys about like a market cap of 3.6. Does it make you like run away? Because it leaves you very little margin for error, right? If something goes wrong, like we screw up with the inspection, and then we're doomed. But these are the rates in around the Toronto area. Like there are high rises in Toronto that are changing hands at 2.5 market caps. It's just the way it is. And
can you tell us a little bit more about these assets? Would you say they're A or B?
They're definitely
assets.
They're good quality assets.
I figured, right.
Good neighborhoods. We've had 0 vacancy since we started any of the 3 properties. Even like we went through 2 turnovers in February, freezing cold, COVID, we rented them no problem with bumps up from 11 to 15. So we're happy with these assets.
From what to what?
1,100 to 1,500, both properties.
With you did a renovation to get there?
No renovations at all. They were in good shape.
Well, that's a nice upside.
I mean, rents are going up a lot in the Toronto area because you got this huge country with only 37 million people. But we're letting in 400,000 immigrants a year, and they're going to Toronto, Vancouver, Montreal. That's it. So we got the demand, and I don't see that changing in the next 20 years. But there's limited room for mistakes. And what happens if interest rates go up 2-3% when we have to renew in 5 years? So I'm worried about that. But even if we go ahead with it, how do we get people to put money in so that we don't have to keep forking over? In this case, it'd be like another $1.5 million.
So let me give you a few thoughts. Low cap rate deals are not going to cash flow. The good news is if you bought it free and clear, you'd make 3.5% on your money, which is awesome. But you could make, as you know, you could probably do a lot better than that, right? I'm assuming Canadian interest rates are around the same as what we're paying here, which is in the high 2s, low 3s. So you can, through leverage of borrowing money cheaper than the cap rate, you can achieve a bit of a levered return on your money. But as you said, if you hiccup and sneeze the wrong way, there goes your cash flow, right? Now, the good news for low cap properties like you went from $1,100 to $1,500 on one apartment. That's a $400 difference in rental income, right? Arguably, your expenses didn't change. You're just creating more top line revenue, which means your bottom line went up by $400 that month, right? Now, what's great about that is if I take $400 and I annualize it, that's $4,800, and I divide it by a 3 cap, right? You've increased the value of your property by $137,000 on one apartment. So how many units is this?
12 units.
Okay. So multiply that by 12. Yeah, you could be around 1.5 million that you could increase your property value, right? Now, the way the game gets played and the way a lot of syndicators like us, we don't do low cap rate deals. We do mid-range cap rates because we invest for cash flow. The way that you play that game is that the appreciation game, the low cap rate game, is you get in, you do that value add, you drive the property value up, and then you either sell it or you refinance it to recoup the capital you've got in. Because if you get increased property value by 1.5 million, then you get in, you drive value up, you reap some of that capital out, and you and your partners are left with no skin left in the game. And you can take that and reinvest it and get your capital back out and make whatever cash flow you make. Even if you don't make much, at least maybe hopefully you can amortize debt at that level, at that cap rate, meaning like you can start paying your debt down and you got yourself a nice big retirement savings account, and you can sell the property 15 years from now and it'll be paid halfway off, right? That's the angle with low cap rate deals. Does that make sense?
Yeah, I think that's our plan. It's like legacy assets. We're thinking 15 years down the road, assuming immigration comes in, property values increase, rents keep going up. And then we don't want the headaches of, like, we don't want the bunch of calls at 2 a.m. saying, hey, there's a fight in Unit 1A. Like, that's not our thing.
You mentioned that your partners are not interested maybe in putting more money in for the level of return that they're getting. Is it more because it's a hassle for them, or they just feel like they can get more money elsewhere? I mean, why did you guys decide to get into this type of asset and this type of real estate in the first place, and has something changed?
So it was diversification for us. So all of us are, like I say, 40s and 50s, business owners, jobs. Stock market's done amazing for us the last 10, 15 years. So we're like, you know what, let's pull some money out, do something different with it, and also have a little bit of fun. And, we came together as a group and we developed a finance committee and a committee that does the maintenance. So it's sort of like a fun thing to do, but there's limits to how much we want to put in of our own cash, because I say, it is not a full-time job for any one of us. It's not like we've turned against it. It's just like, we put in enough. We put in whatever, $1 million on the last deal.
Yeah. Your next step would be to raise investors. That's your next step. If you guys don't want to do it. Yeah, it is. It's a tough sell to convince investors that a 3.5 cap is a good investment, but you could play the game that I just said, is you get in a 3.5 cap, that you get in, you raise value, and there's syndicators all day long that are doing 3.5 cap deals in the US. And they're doing what I just described. They're going in, they're adding value, they're increasing rents over time. They're kind of riding appreciation, riding inflation up a bit, and creating value in the property. Now they're likely selling the asset in years between 3 and 5 to reap some of the profit that they got out of the property. So you could look to do that and just get investors in, or put them in, get rents up, refi, give as much of their capital back as you can. And that you just got to make sure. I mean, for me, what would make me nervous, or what I would like, a risk I would want to mitigate, is some sort of an operational reserve on the property. So Justin and I own a good bit of real estate, and we know that just things always go not according to plan. There's always curveballs, even on A-class property, right? I would want to make sure, especially if you're playing with other investors' money, you and your partners, like, you have a bad couple of months, you have a low month or something like that, you guys could go and just pass a hat around and come up with $100,000 to keep the company going. Not that you've had to do that, but you could, right? Yeah. With investors, that's a whole nother game. It's called a cash call. And it's a really easy way to get a bad smear on your reputation, because you're going back to investors asking them for more money. So I would raise a few extra dollars than what you need and have it just sit in operating reserve that you can tap if you need to. Just understand, every dollar you raise is going to dilute the investment pool and make the return on investment less and less for investors. So be careful how much money you raise.
Yeah. I'm still, curious more about like your goals, Larry, and your teams, because it sounds like you guys are all very happy doing your other jobs, and you kind of pulled together, got into real estate a bit. If you go this next route and you make a leap and take on investors, you're building not only the company that buys the real estate, but you're building an investment company, right? And if that is not exactly what you guys are interested in, you've really got to think about who's going to do what. Like, Matt and I are 2 members of our company, and we have a company, and we focus on raising money. We have investor relations, right? We do a lot of educational content because we're always looking for more investors. There's a lot that goes with that. So I would really want you guys to drill down and think about your goals. And if it's if it's like been a fun venture that you guys got into and that's fun and cool, great. And if you're looking now for sort of higher returns, then maybe there's a different vehicle or different types of partnerships that you could get into. For example, investing in someone else's syndication that's doing it full time, or partnering with someone that can take on that legwork and you just become a passive investor and put that money in. Well, you're still in real estate, but you don't have to take the burden of the time.
That's a great point, in that you got to decide what you want to do. The only way to buy if you like the low cap properties and the A-class assets and stuff like that, I personally would keep doing it yourself. But if you are looking for just a great return on your money, build your wealth, that kind of thing, there's plenty of syndicators out there that are maybe not playing, that are playing an A-class space, but I probably wouldn't invest with that. I wouldn't do that because you could just do your own deals. I would invest in probably more cash flowing assets for syndicators that are doing B and C level stuff, and that are maybe more cash centric, that maybe aren't 3.5% cap rates, but are probably 5.5%, 6% cap rates. Those syndicators are out there too, and they can help you diversify a bit. And that's a great point that Justin said. Anybody that wants to invest in real estate should decide what they want to be when they grow up in real estate investing. You know, like, what do you want to be? You want to be an active operator and have thousands of units in your portfolio, or do you want to like just benefit your life by just building up your real estate ventures? So those are options that you got to consider.
Okay. No, it makes sense. You're right. I think when you say it, Justin, you're right. I don't want to get into the investment game. If there's one or two other guys who want to join us, like become part of our existing team, that's fine. And maybe they put in 500 G's each. And that gives us $1 million for a down payment. And that's fine. But I don't want to start, grabbing people and like basically what you guys do, which is fantastic. You guys are great,
but
it's not
this is our vocation though. This isn't like a side hustle. This is what we do, right?
I get it.
And I get that you and your partners have other things that you do, right?
Exactly,
like this isn't the full-time gig for anybody, right? And I think that's what Justin was referring to in that, like, do you want to be passive or do you want to eventually be active? And there is a very clear fork in the road on going active versus going passive.
Right. And to that point, if you guys were still comfortable with the returns you're getting and you're having fun doing it together, then go pick up a few more properties the way you've been doing it. But it sounds like sort of the novelty is worn off and now you're looking for something that's going to be, provide a little bit more of return. Or you're right about that inflection point where the time is about to pass over the point that it's going to become more of a burden than what you want it to be. If you're still interested in real estate, you can find active partners and you can be sort of the money behind the partner, whether it's flipping or apartments or multifamily, whatever you want to get into. There are people out there doing those kinds of deals that maybe you want to partner with.
Sounds good.
There you go. It's just great testament to there's not one path to freedom in real estate. I think there's 3 ways you can make money in real estate: cash flow, appreciation, and tax advantages. The right deal gives all 3. That deal may give a little bit of all 3 of them. What Larry's got is something that's got enormous appreciation, but just because of forced appreciation on cap rate. It's hard to beat that.
Yeah. And listen, I know I said it a few times to Larry, but I think goals and what you want out of your investing. Do you want to build a full-time thing like you and I are doing, or do you want to just invest with your buddies and go buy a few properties, which is what Larry's doing, and that's awesome. But at some point, you start to think about the bigger picture and whether we want to go down that path or not. So your goals can change, your plans can change, but you should always be sort of checking in so that you make sure you're going down the path you want to be going down.
Thanks for watching, guys, and have a great profitable week.